In this video, we are going to find 5 dividend kings that are worth buying today and holding forever. But first, what is a dividend king? Well, it is the most elite group of dividend stocks. These are companies that are growing their dividends every single year for at least 50 years. So companies that are on this list started to grow their dividends at least in 1975. Just to put things into perspective, that year, Microsoft was created. It was also the end of the Vietnam War. And the Sex Pistols played their first concert. So being a member of this club is quite an achievement, but it takes just 1 year of not growing dividends to lose this status. And that is why companies that are dividend kings are more likely to continue growing their dividends into the future. And to determine which 5 companies are the crème de la crème of this group, we are going to look at 3 main aspects of a dividend. The dividend yield. That is how much cash you get back each year compared to what you paid for the stock. The payout ratio. That shows how much of the company's profits are being shared with the shareholders. And finally, the dividend growth rate. This tells you how quickly a company is increasing its dividend payments over time. So, let's start with automatic data processing, ticker symbol ADP. This company helps businesses manage their payroll, benefits, and human resources by providing software and services that automate these processes. So the dividend yield of automatic data processing is around 2.2%. So that is okay, but we would like to see it a bit higher. The payout ratio is 59.5%. So that, on the other hand, is just a bit more than what we would like to see. If it's below 50%, then we know it is a secure dividend. The company still has plenty of cash to grow the business, or even if they will have a bad year, they will still have enough money to pay and grow the dividend. But what is exceptional about this dividend king is the 5-year growth rate. It is 11.6%. That is incredible, because even though our dividend yield may not be the best, but if they can continue to grow the dividend at the same pace or even a bit slower, we will get some great income from such an investment. And let's also value this company using our dividend discount model calculator. So the current price is around $292. Annual dividend is $6.16, and for the last few years the dividend was growing at over 11%. So let's be conservative and we will enter an 8% dividend growth rate. That gives us a present value of a stock at around $332. So that is a really nice deal right now. A second company that is one of the best dividend-paying companies is Altria, ticker symbol MO. Altria is a tobacco company that makes and sells cigarettes and other tobacco products in the United States. The dividend yield is 7.1%, so that is absolutely incredible. To find a dividend king that pays over 7% dividend is very rare. The payout ratio is 78%. It is really high, but it is not uncommon for tobacco companies to have such a high payout ratio. So even though we would like to see it closer to 50%, this is the reality for Altria and for the industry. And finally, the 5-year growth rate is at 4%. That is a nice, decent growth, nothing exceptional, but nice. So in contrast to automatic data processing, the power of this dividend is the current dividend yield. In the first year of our investment, we will get over 7% of our money back. Not bad. And let's value Altria using our DDM calculator. So the current price is around $58. Annual dividend is $4.08, and the dividend growth rate is at a reasonable 4%. That gives us a present value of a stock at around $70. That is nice. Altria seems undervalued when we use the dividend discount model. Of course, always remember that these valuations are simplified and should be used only as a part of a valuation process. And if you would like to get access to not only this dividend discount model calculator, but also 3 other intrinsic value calculators, then you can do it by becoming a Patreon of this channel. The link is in the description. Third company we are going to take a look at is Archer Daniels Midland Company, ticker symbol ADM. This business is a global food processing company. It has a dividend yield of 4.3%. That is a very nice yield. The payout ratio is 42.4%. So exactly what we are looking for. We get over 40% of the earnings as dividends, but at the same time, the majority of it stays in the company, allowing it to grow or prepare for the future. The 5-year growth rate is 7.4%. So that is a very nice growth. This company is a mix of nice dividends and a very nice growth. So something between the other 2 companies we analyzed today. And let's take a look at the valuation. So the current price is around $48. Annual dividend is $2.04. And when it comes to the dividend growth rate, let's use 6%, so something slightly below the growth we saw in the recent years. That gives us a present value of a stock at around $54. So it is basically fairly valued right now. Next up, let's take a look at Lowe's Companies Incorporated, ticker symbol LOW. It is, of course, a home improvement retail chain. It has a dividend yield of 2.2%, so nothing special here. The payout ratio is 38%, and that is very good news. It is not only a secure dividend, but also we can see there is a lot of space for growth of this dividend. And speaking of growth, its 5-year growth rate is 16.4%. That is absolutely incredible. So it's another company with an average dividend yield, but with a crazy amount of growth. So even though for the first or second year our dividends may not be incredible, over a longer period of time, they should be absolutely smashing it. And let's use our dividend discount model calculator to value it. So the current price is around $219. Annual dividend is $4.60. And when we come to the growth rate, we have to be conservative here. First of all, the dividend discount model does not allow to use a higher growth rate than the discount rate. Because of the math, the result would be negative. But also, we should be conservative here because predicting that the growth will continue to be at around 16% for the next 5 or 10 years is probably too optimistic. But if we use a dividend growth rate of 8%, we will get a present value of a stock at around $248. So even with the growth slowing down by 50%, we still get a nice deal when it comes to lows. And the final stock on our list is PepsiCo, ticker symbol PEP. We all know PepsiCo, it makes and sells popular beverages and snacks. The dividend yield is 3.8%, so that is a nice yield. The payout ratio is 65.3%, so we would like it to be a bit smaller, but it is nothing crazy. I would definitely not call it a red flag or get worried about it. The 5-year growth rate is 7.3%. So yet again, we have a company with a really nice dividend yield and with a really nice growth rate. We get the best of both worlds. And what about the valuation? So the current price is around $142. Annual dividend is $5.42, and for the dividend growth rate we will use 6%, just slightly below the growth rate we saw in the last few years. And that gives us a present value of around $143. So Pepsi seems to be fairly valued right now. Like I said before, this model is really useful for dividend-paying companies, but it cannot be the only way we value a company. We should also look at discounted cash flow analysis, comparable company analysis, or the PEGI ratio to get a better understanding of the current intrinsic value of any company. And you can get access to all such calculators on our Patreon page. If you would like to learn more about PepsiCo or Altria, then check out my analysis of those companies. Thank you so much for watching and see you in the next one.